Hi everyone, welcome back to the channel. Today, we're discussing something that completely turned the game for me as an investor: creative financing. If you've ever felt stuck because you don't have a stack of money or perfect credit to buy property, you're gonna wanna watch this video. We're gonna throw open the doors to the unconventional channels through which smart investors acquire their buys, all through something known as leverage, which amounts to leveraging other people's money. The techno jargon being leverage, and some pretty brilliant substitute financing arrangements. Bear with me, because this is heavy stuff. So what's creative financing then? Basically, it's all the methods you can buy property that aren't a cash sale or a normal bank loan. The whole concept here is to use as much leverage as you can. That means you're borrowing with as little of your own money as possible. This is the magic formula that allows professional investors to put together a portfolio rapidly, sometimes without investing one of their own dollars in the initial deal. Asset-based lending, like hard money loans, accounts for a major part of this universe, and these are typically short-term loans for 6 months to 3 years. Here, speed and flexibility do come with a cost. You'll see rates of interest much higher, typically in the 12 to 18% range. And the lenders indemnify themselves by having loan-to-value ratios very low, perhaps 65 to 70%, so there's always plenty of cushion equity in the home. Okay, but why would you go this method at greater cost? There are 3 enormous reasons. Number 1 is inaccessibility. Face it, not everyone makes the grade by a bank's strict standards. If you've got poorer credit, an unconventional income source, or simply can't scrape together an enormous down payment, creative financing opens up access where conventional banks have closed the door. Second is maintaining your capital. This is enormous. By avoiding the traditional loans, you are also keeping away from their huge closing costs, origination fees, and mortgage insurance. That leaves more of your funds in your pocket, and you can utilize it efficiently and even purchase several properties as opposed to one. And third, it's a powerful response to the cycles of the marketplace. If the rates are sky high or the economy is slowing, methods like buying subject to an existing mortgage become extremely valuable. You can take on an old seller's low interest rate or help someone in distress, making a win-win. We'll make this as plain as the nose on your face by comparing it to something you already have a concept for. Traditional financing is your traditional bank mortgage. It's fixed terms, fixed payments, and plenty of government regulation. It takes weeks to qualify you, the standards are stringent, but you do get lower interest rates, normally 3 to 7%, but you pay top dollar for closing costs. Creative financing is the opposite. The terms are flexible and negotiable. There is minimal regulation, so the deals can close in days rather than weeks. Qualification is very flexible. The catch? The interest rates are higher, as we stated, 12 to 18%, but your upfront costs are often much, much lower. Now, this is a critical principle that you need to understand. Creative financing is not usually an infinite solution. What you're essentially doing is taking a long-term loan negotiation and making it a short-term game in terms of liquidity and risk transference. You are intentionally substituting the low rate of interest and solidity of a 30-year bank loan for the speed and flexibility of an expensive bridge. Think of it literally, a bridge. You use it to get from point A to point B. The system and cost of private money make it not an option for the long term. Thus, creative financing is really a bridging strategy. This means that you must have a properly structured, planned exit strategy, usually a refinance with a traditional lender once you've refurbished the property, or an outright sale, and that it must be accomplished within a reasonable time frame, usually between 6 months to 10 years. We need to learn the lingo before we get into the actual strategies. Let's get through some of the most important terms. One is LTV, or loan-to-value ratio. This is a ratio of loan value to appraised value of property. If a lender requires a 70% LTV on a $100,000 house, they will only give you $70,000. That lower LTV is their second choice. Amortization is second. This is nothing more than paying out the loan balance over a period of time, using periodic payments that both pay interest and shave off the principal. And then there's LTC, or loan-to-cost ratio. This is a doozy for developers and flippers. This calculates the loan amount compared to the project cost, purchase price plus rehabilitation cost. And finally, the balloon payment, another timeless type in seller financing. The loan might be calculated to be more than 30 years, so the payments each month are tiny, but the entire balance remaining is payable all at once after, say, 5 or 10 years. Some other key terms to round out your vocabulary. Points. This is an origination fee you make at closing. 1 point is 1% of the loan. On a $100,000 hard money loan, 2 points will cost you $2,000 at the beginning. Equity sharing. This is a fascinating one where 2 or more parties share ownership. One good instance is where an investor provides the down payment and an occupier who is living in the house and settling the monthly costs. They both enjoy appreciation on the property. And agreement for deed or land contract. This is an installment plan with the seller directly. You pay them in installments, but here's where it gets tricky. The seller still holds the legal title until you've paid the entire contract. Now let's talk about the players. Hard money and private money lending is when you get the money from a private company or individual, not a bank. These are the individuals who lend money to investors to buy, fix up, and flip or rent property. The massive advantage here is flexibility and speed. These deals can settle in a matter of days. They're perfect for time-critical transactions, like grabbing an ailing property at auction that needs to be rehabbed urgently. But you're paying for that speed. It costs 12 to 18% interest rates, 65 to 70% LTV maxes, and those points we talked about, usually 2 to 5% down. That's a high-expense model, so it's a terrible option for long-term holding. It forces you to be a hands-on investor. You have to invest that money to create value in a hurry with rehabbing and then move on by selling or by refinancing. All right, so let's dig into the very first major strategy, seller financing. And that's just as it sounds. The property owner is the bank. They cut out the middleman and finance you themselves. You execute a promissory note, which is really just an IOU that outlines all of the terms: price, down payment, interest rate, pay schedule, and what happens in the event of default. To make it legal, the seller will also record a security instrument, a deed of trust or a mortgage, on the property. This gives them legal powers to foreclose in case you don't deliver your part of the bargain. The beauty here is the flexibility. It's a simplified path to ownership, especially for buyers who cannot qualify for a traditional loan due to credit issues. Now, a more advanced version of seller financing is the wraparound mortgage, or all-inclusive trust deed. Here's how it works. The seller creates a new loan that wraps around their existing mortgage. You, the buyer, make a single monthly payment to the seller. The seller then uses part of that money to keep paying their original mortgage to the bank. It can be a consideration for raising capital when a new bank loan is not available. But, and this is a big but, it doubles the risk on the seller. They've created a second mortgage without having paid off the first. This almost always triggers the due on sale clause on the original mortgage. If the bank finds out, they can insist on paying back the whole loan immediately, and the seller is facing 2 gigantic debts. It's a pretty risky thing to do. Well, let's discuss the good and the bad. For purchasers, the benefits are enormous. Terms flexibility, potential cost savings on closing, home ownership access despite credit issues, and a faster closing process. Advantages to the seller are that they can sell quicker. They have a chance to receive interest income. They save taxes on deferral of their capital gains, and they expose their property to considerably more buyers. But there are risks as well. Buyers typically receive higher rates of interest and shorter terms that end up in that scary balloon payment we talked about. You'll also lose some of the consumer protections that you'd enjoy with a regulated bank loan. The huge risk for the sellers is the default of the buyer. And if that happens, you're not a bank. You're now the owner of the property who gets to go through the costly and lengthy foreclosure process. Okay, this is a doozy that gets a whole lot of discussion. The subject to sale, or sub-to. In a sub-to sale, you're buying the property subject to the existing mortgage. I want to be extremely clear about the 3 general steps. First, the title becomes yours. You're the legal owner of the property. Second, and this is crucial, the mortgage that currently exists stays in the seller's name. It's still reflected on their credit report. Third, you simply make the mortgage payments on their behalf. You have a contractual arrangement with the seller to make them, but the legal responsibility with the bank is still theirs. So why on earth would anyone ever do this? The appeal to a buyer is huge. You usually need little or no down payment. You assume an existing loan that probably has a much lower below-market interest rate, and you altogether skip the traditional mortgage qualifying process. It's a home run, right? Well, not so fast. The risk in this case is entirely one-sided, and it falls on the seller. The seller is liable legally. If you, the buyer, fail to make payments, the bank sues the seller. Their credit is ruined, and they are foreclosed upon. Additionally, just as in the case of the wraparound mortgage, passing the deed virtually always invokes the due on sale clause, allowing the bank to demand the loan be paid. This is a high-risk, high-reward strategy that requires maximum trust and stringent contracts. And then there's rent-to-own, also referred to in two variations, lease options and lease purchases. Both involve a renter paying a non-refundable initial option fee to purchase the home someday. Along with rent, they typically pay a separate monthly premium that may be credited toward the eventual down payment. Here's the key difference. A lease option gives the tenant an option. Upon expiration of the lease, they have the option to buy the house, or they can vacate. A lease purchase is a contract that binds the tenant to buying the house upon lease expiration. Failing to buy is a breach of contract. For the buyer-tenant, the benefits are good. It gives you time to get ready, save up for a bigger down payment, or shore up your credit rating. You're assured a locked-in price of purchase, typically, also, which protects you in case the market goes up between the time you rent and when you purchase. And you get to try out the house and the area first before fully committing. But the risks are genuine. It's forfeiture, again. If you decide not to exercise your option, or if you miss a payment on your rent, you forfeit it all. The first option payment and any subsequent monthly payments that you made. You should enter into these deals with a legitimate plan to really get the financing to buy when the time comes. Our final key strategy is the land contract, or contract for deed. This is another form of seller financing in which you make installment payments to the seller over time. The key twist here is that the seller retains the legal title, the deed, until you've made the very final payment. As the buyer, you get what is called equitable title. That is to say, you have the rights of ownership and the duties of ownership. You live in it, you pay the taxes, you fix it up. You do not, however, have the actual deed. This creates a simple structural unfairness. You're acting like an owner and paying like an owner, but without security of being the legal owner. Let's break down that risk. As a buyer, it's significant. If you default on a payment, you risk losing it all, the equity you've built up through your payments. In some states, you can be foreclosed upon after just one missed payment. You're also rolling the dice that several years from now, the seller will be able to give you a clean title, which is not necessarily guaranteed. For the seller, the danger is that if the buyer defaults, you may not be able to simply evict them. In most states, the courts treat this as a mortgage, so you'll have to undertake a long and costly foreclosure procedure to regain your property. It's ugly for all parties involved if it doesn't work out. So let's summarize. This table is your cheat sheet. With seller financing, you get the title. The seller bears the risk of foreclosure. Your edge is flexible terms, and you get out by refinancing that balloon payment. In a subject-to transaction, you take the title. The seller has credit risk and due on sale. Your benefit is low down payment and good rate, and you exit by reselling or refinancing to pay off the old loan. With a lease option, you don't get the title. The seller only cares about vacancy. You have time to fix your credit, and you exit by taking out a loan to exercise the option. And with a land contract, you do not get the title. The seller can be required to foreclose. Your benefit is no bank approval, and you exit after the final payment when you get the deed. Now, we need to talk about the one biggest legal danger in creative financing, the due on sale clause. It's a provision in almost all standard mortgage agreements. that says if the property is sold or transferred without the lender's approval, the lender may call for the entire loan balance to be paid in full immediately. Poof! It's over. By assigning the deed in a subject to or granting a wraparound mortgage, you are essentially calling upon this provision. If they find out about it, they can call the loan due. Not theoretical risk. It's a contractual right they have. Hold on a minute, you say? There's a federal law, the Garn-St. Germain Act, that provides some exemptions. It says that lenders cannot insist on a due-on-sale clause in 9 different situations, but they're all relating to your primary home and immediate family. We're talking about moving to a surviving spouse, adding a spouse to the title, moving to the children, or putting the property into a specific kind of living trust where you remain the occupant. Here's the important point investors need to know. Examine those exceptions. They are exclusively for protecting primary homes and families. There is no exception for an arm's-length sale to a stranger that is an investment sale. This reaffirms that Congress never voted to legalize commercial subject-to transactions. When investors employ these tactics, they are basically gambling on the lenders not taking the trouble to enforce the clause if payments are met on time. But you're always operating in the lender's discretion risk zone. It's one to understand and, of course, respect. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.